The SEC just made a move that could turn the stock market into a 24/7 trading machine. No closing bell, no waiting for Monday, no more T+1 settlement delays, and almost nobody is talking about it. This is not a crypto takeover. This is Wall Street putting real stocks on blockchain rails, and it could change how prices move after earnings forever. Right now, when you buy a stock, the trade does not fully settle until the next business day. Your cash is locked, risk sits in the system overnight, and the market shuts down every weekend. But the SEC has approved a pilot that lets the main clearing engine of the US stock market moves certain stocks, ETFs, and US Treasuries onto blockchain infrastructure, not fake tokens, not speculative coins, real regulated securities. This is the plumbing behind every trade you make, and when plumbing changes, price behavior changes instant. Settlement means trades finish immediately. Less capital trapped in clearing. Market makers can trade more with the same balance sheet. Risk goes down, speed goes up. This surprised Wall Street because this is not just a back-end upgrade. Nasdaq wants to list tokenized stocks. The New York Stock Exchange is planning 24/7 trading. That means the stock market could start behaving like crypto. Always on, always moving. Think about earnings. Today, a company reports after hours and the stock gaps the next morning. In a tokenized market, the price moves the second the news drops. No gap ups, no BAP ups. Gap downs, just continuous price discovery. That means faster reactions, less overnight surprise, more intraday volatility. Day traders love that. Long-term investors need stronger discipline. Now pay attention to this. We are already seeing money rotate into exchange operators, clearing and settlement, tech, blockchain infrastructure firms, and market data providers. Their earnings did not explode, but their valuations are moving because investors are pricing in future trading volume. More hours plus faster settlement equals more trades equals more revenue. 2 years ago, regulators were cracking down on crypto. Banks avoided blockchain. Fintech firms were under pressure. Now stablecoins have a legal framework. Broker-dealers can hold tokenized securities. Banks can connect to blockchain systems. Futures markets can use digital collateral. That is a complete policy reversal. Here's what could happen next. A full market structure law for tokenized assets. If that happens, this pilot becomes permanent. Right now, this system is institution only. Retail does not get access yet. But every major market upgrade followed the same path: institutions first, retail later, electronic. Trading options, fractional shares. When tokenized stocks reach retail, you could get 24/7 trading, instant cash after selling, smaller position sizes, and global liquidity at all hours. Weekend news could move your portfolio instantly. No more waiting for the opening bell. Imagine Sunday night, a mega cap pre-releases earnings. Today, nothing happens until Monday. In a tokenized market, price moves immediately. Faster price discovery, less gap risk, more continuous movement. Portfolio hedging becomes more active. Passive investors see constant motion instead of big jumps. Potential winners include exchange operators moving into 24/7 markets, market makers benefiting from higher volume, fintech platforms connecting wallets to brokers, and data providers selling real-time analytics. Potential losers include legacy intermediaries that profit from slow settlement systems built around overnight funding spreads and firms relying on timing inefficiencies. This is creative destruction in market infrastructure. Institutions are not chasing hype. They are focused on capital efficiency, collateral mobility, cross-margining across assets, and programmable compliance. Smart contracts could automate dividends, corporate actions, and compliance checks. Lower costs, higher margins, higher valuations. But there is risk. 24/7 markets mean no cooldown period. News hits instantly. Liquidity changes by time zone. You could see flash moves on weekends when volume is thin. Retail traders treating stocks like crypto could increase volatility. So this is opportunity and risk. This pilot runs for 3 years. Initial rollout second half of 2026. Institutions only, retail access comes later. So this is not a trade for tomorrow morning. This is a long-term structural shift. The stock market has had 3 major eras: paper certificates, electronic trading, now tokenized settlement. Each shift increased speed, increased volume, and reduced friction, and each shift created new market leaders. The investors who understood the infrastructure shift early made the biggest gains. If this works, we get always-on markets, instant settlement, programmable stocks, and global liquidity flowing into US equities 24/7. That could increase valuations for market infrastructure companies and permanently change how price reacts to earnings. But it could also bring higher volatility and new risks. Would you trade stocks on weekends if the market was open 24/7? Or do you think non-stop trading would make markets too dangerous for retail? Drop your answer in the comments and tell me which companies you think benefit most from tokenized stocks.